So just what is the Earned Income Tax Credit? Some simply call it EIC, and why is it found in the Payments section of the 1040? The Earned Income Tax Credit is a credit for certain people who work and have low wages. The EIC may also result in a tax refund. The IRS website definition and background of the Earned Income Credit goes something like this. The Earned Income Tax Credit is a refundable federal income tax credit for low to moderate income working individuals and families. Congress originally approved the tax credit legislation in 1975 in order to provide an incentive for people to work. When the EITC is greater than the amount of the taxes that are owed on the return, it results in a tax refund to those who claim and qualify for the credit. For tax year 2016, approximately 27 million taxpayers received more than $67 billion in EITC. The average received per taxpayer was $24.55. To qualify for EIC, the taxpayer must have earned income from employment, self-employment, or another source, and must meet certain other rules. In addition, the taxpayer must meet the additional rules for workers without a qualifying child or have a child that meets all of the qualifying child rules. So how much can I earn and still qualify for EIC? Well, this credit is targeted at households with modest incomes, so if you earn too much, you may not qualify. But just how much can you earn and still qualify? It depends on how many qualifying children you have, and we'll define qualifying children in a moment. In tax year 2016, if you were married filing jointly, had 3 qualifying children, and earned less than $53,505, you would have qualified for this tax credit, or even for a refund check. So how much is the credit? The EIC varies based on income and family size. Last year, a family with 3 or more qualifying children could have received a refund of up to $6,269. Taxpayers may get money back, even if they had no tax withheld. You qualify for the Earned Income Credit if you are single, or if you're married, you don't use the married filing separate status. You, your spouse, and children, if applicable, all have Social Security numbers. You also qualify if you have income from earnings, for example, from a job, your own business, union strike benefits, certain long-term disability benefits, and you did not receive more than $3,400 in interest or dividends, or income from rentals, royalties, or stock and other asset sales during the year. You qualify if you and your spouse aren't being considered as a child on someone else's tax return for purposes of the Earned Income Credit. And you qualify if you're a citizen or resident of the United States. You qualify if you do not happen to have a qualifying child, but you are between the ages of 25 and 65, under age 65 at the end of the year, not the dependent of another person, and you've lived in the United States for more than half the year. If you're married and file a joint tax return, either taxpayer can meet the age test. The amount of the credit can be determined from the Earned Income Credit table that's found in the instructions for Form 1040 or in IRS Publication 596. Use the table to look up the taxpayer's income, family size, and then find out the amount of credit to which the taxpayer is entitled. Those whose incomes, filing status, and family size match the table in the right spots qualify for the biggest credits. The rules have been eased to result in higher credits for many households, especially those with 3 or more qualifying children. Those with incomes above the phase-out threshold qualify for lower credits until they reach the point where the credit is eliminated completely. Does my child qualify? Well, to qualify, the child must be your son, daughter, stepchild, adopted child, or a descendant. Your foster child, placed with you by an authorized agency or court order, or your brother, sister, stepbrother, stepsister, or a descendant of one of these. To qualify, the child must also be age 18 or younger as of the end of the year, unless he or she is a full-time student, in which case the student must be 23 or younger. There is an exception. A person who is permanently and totally disabled at any time during the year qualifies, no matter how old. To qualify, the child must also be a resident with you in the United States for more than half the year. Now here's an example. Shelley, who's filing head of household, has a total tax, which is line 63 of the 1040, on her federal return of $140. Total tax of $140. She had $100 in federal withholdings on her W-2. Her earned income credit was calculated to be $1,800. Does Shelley get a refund? And if so, how much? Well, her tax was $140. She had withholdings on her W-2 of $100, so her balance due is $40. But she had EIC of $1,800. So her refund is $1,760. EIC is a refundable credit. Now assume Shelley's filing status is married filing separate on her tax return. Will this make a difference on the amount of her refund? Absolutely it will. A married filing separate tax return does not qualify for the earned income credit. Let's take a look at another example. Bob is a 24-year-old single taxpayer with no qualifying children. He earned $21,000 for the year. According to the rules for EIC and the EIC tables, how much earned income credit should he receive? Well, if you answered none, you're correct. To qualify for EIC, a taxpayer with filing status single must be at least age 25, but under age 65 at the end of the calendar year. In summary, the Earned Income Credit, or EIC, computation is based on filing status, number of qualifying children, earned income, and adjusted gross income. If the circumstances are right, taxpayers who have no children may also qualify. The EIC amount is determined using worksheets and the EIC tables. The EIC is entered in the payments section of the return and is a refundable credit. Next, let's look at some review questions. 10. If mortgage interest paid was not reported on a Form 1098, enter it on line 11 of the Schedule A. This might be the case if an extra house payment was sent late in the year and the lender did not properly credit the additional payment. And if interest was paid to an individual from whom the taxpayer bought the home as a personal sale, this interest is also reported on line 11, along with the seller's name, address, and tax ID number. Any points not listed on the Form 1098 may be found on the settlement statement. Also, if a home improvement loan was taken out that was secured by the house, and part of that loan money was used to improve the residence, then some of the points may be deductible. These non-1098 point amounts go on line 12 of the Schedule A. Still in the interest section of Schedule A, on line 13, we report mortgage insurance premiums, most often called PMI, or private mortgage insurance. Homeowners who are unable to make a down payment of at least 20% of their home's purchase price are often required to buy this insurance. This insurance protects the lender in case of default on the loan. The tax deduction for mortgage insurance was extended through 2016 for mortgages taken out or refinanced after January the 1st, 2007. 2016 will more than likely be the final year for this particular deduction. If adjusted gross income, or AGI, reaches or exceeds $109,000, $54,500 if married filing separately, the deduction is totally eliminated. Interest paid on money that's borrowed to buy investment property, such as stocks and bonds, can be deducted on line 14 of the Schedule A. We complete Form 4952, Investment Interest Expense Deduction, in order to claim this interest. We add lines 10 through 14. There's no limit here either, and this total amount of interest paid goes on to line 15. Next, we'll cover charitable gifts. The IRS allows taxpayers to deduct donations given to approved charity sponsors, church donations, Salvation Army, Goodwill, and so forth. The next section of Schedule A is where these gifts are detailed. On line 16, enter all the gifts by cash or check that are made to qualified charities. This includes contributions to religious groups, churches, synagogues, and mosques, nonprofit organizations, the Salvation Army, Red Cross, Goodwill Industries, United Way, to name a few, veterans associations, not-for-profit schools, and public park and recreational facilities. If a gift was $250 or more, the taxpayer must have a receipt from the recipient. Gifts of property are reported on line 17 of Schedule A. On this line, we enter the value of the used clothing, household goods, or vehicles that were donated. Keep itemized lists of what was donated and its fair market value. The definition of fair market value: the price at which the property would change hands between a willing buyer and a willing seller. Keep these itemized lists for records of proof. If the amount of any single non-cash contribution is greater than $500, then Form 8283, non-cash charitable contributions, must be completed and attached to the Schedule A and to the tax return. And if the deduction is more than $5,000, the IRS may require appraisals of the donated property. Travel costs to do charitable work can also be deducted, as well as out-of-pocket expenses related to a charitable endeavor, such as stamps for a group's mailing. These amounts would also be included on line 17 of the Schedule A. There are some contribution outer limits. Annual cash contributions cannot exceed 50% of adjusted gross income. Annual gifts of property, such as stocks, bonds, and artwork, cannot exceed 30% of adjusted gross income. If more than the outer limits are donated, the taxpayer can carry over the non-deductible amount. The taxpayer has 5 years to deduct it on future tax returns. If there is a carryover from last tax year, enter the allowable amount again within the percentage guidelines on line 18 of the Schedule A. We add lines 16 through 18 in the Gifts to Charity section of Schedule A. This amount represents the deductible gifts to charity and is totaled on line 19. Next, we'll move on to casualty and theft losses, Schedule A, line 20. Now, there's never anything good when a person is the victim of a casualty or theft. The IRS understands this and allows taxpayers to recover some of their losses at tax filing time. Most taxpayers think they can deduct casualty losses only if they suffer catastrophic damages. It's true that those victims do get some special tax options, but taxpayers don't have to live through a fire, a flood, a hurricane, a tornado, earthquake, or other catastrophe to file a casualty deduction. Losses from theft and vandalism are eligible losses, as are damages from an automobile accident, as long as it wasn't the result of driver negligence. Casualty and theft losses are reported on Form 4684. However, taxpayers don't get to deduct the full amount of an unexpected loss. We complete Form 4684 to determine how much can be entered on line 20 of the Schedule A. Form 4684 first reduces the loss by $100 and then by 10% of the adjusted gross income on the return. Next, we'll move on to job and miscellaneous deductions. The next section of Schedule A takes into account money that's spent in connection with a job, as well as a variety of miscellaneous expenses. This catch-all section has a threshold that taxpayers have to meet before these expenses can be deducted. The total expenses must exceed 2% of adjusted gross income. For a taxpayer making $40,000, that would mean that these expenses must go over $800 before they can be deducted. On line 21 of Schedule A, enter the total of all job-related expenses for which there was no reimbursement. Some of the deductible items are professional memberships, journal subscriptions, uniforms, and the cost of keeping them clean, expenses of looking for another job in the same field. We file Form 2106, Employee Business Expenses, if any travel, transportation, meal, or entertainment expenses are claimed. Form 2106 then transfers to line 21 of the Schedule A. Even the IRS realizes how complicated tax filing can be, so it allows payments to a tax preparer as a miscellaneous deduction. The cost of tax preparation software programs and any fee paid for electronic filing can also be deducted. These amounts go on line 22 of Schedule A. Taxpayers can deduct certain other expenses as miscellaneous itemized deductions that are subject to the 2% of adjusted gross income limit. On Schedule A, line 23, deduct expenses that are paid to produce or collect income that must be included in your gross income. Hobby expenses, but generally not more than hobby income. safe deposit box rental, repayments of Social Security benefits, legal fees that are related to producing or collecting taxable income or getting tax advice. Add all work-related and miscellaneous expenses shown on lines 21 through 23. Enter the total on line 24 of the Schedule A. Next, we calculate if there is indeed enough to deduct. On line 25, we enter the AGI from line 38 of the 1040. We multiply that income by 2% and enter the result on line 26. This is the threshold that expenses must exceed. Subtract this line 26 percentage from line 24's total expenses and enter the difference on line 27. This is the allowable deduction amount. If the 2% of AGI threshold amount is larger than the total expenses, then unfortunately there's no deduction. We enter 0 on line 27 of Schedule A. The expenses we detailed on the previous lines were limited by 2% of adjusted gross income, but the IRS removes that restriction on expenses in 7 specific areas. One of the most common deductions listed here by individual taxpayers is gambling losses. We enter gambling losses on line 28 of the Schedule A. Remember that while gambling losses aren't restricted by a percentage of income, they are limited by good luck. Deduct gambling losses only up to the amount that was won. That is, if the taxpayer won $1,000 and had losses of $1,700, then he or she can only deduct $1,000. And don't forget to include any winnings on line 21 of the 1040 as income. Other miscellaneous deductions allowed on line 28 include casualty and theft losses from income-producing property, federal estate tax on certain inherited income, amortizable bond premium on certain bonds, the deduction for repayment of amounts under a claim of right, and certain unrecovered investment in a pension, and impairment-related work expenses of a disabled person. For more details, consult IRS Publication 529, Miscellaneous Deductions. So we add the amounts on lines 4, which is your medical, 9, which are the taxes, 15, the total interest, 19, charitable deduction, 20, casualty and theft losses, 27, job and miscellaneous deductions, and 28, other miscellaneous deductions. We enter the total on line 29 of the Schedule A. Then we carry this amount to line 40 of the Form 1040. If the total itemized deductions on line 40 of the Form 1040 exceeds the standard deduction amount for the taxpayer's filing status, then it will benefit the taxpayer to itemize his or her deductions and file Schedule A. In summary, some taxpayers cannot take the standard deduction and must itemize. One example of this is if the filing status is married filing separately and one spouse has already filed his or her return and itemized on the return. Examples of types of expenses that indicate looking at itemized deductions on the tax return are large out-of-pocket medical and dental expenses, state and local income taxes, sales tax, real estate taxes, and/or personal property taxes, mortgage interest, gifts to charity, casualty, theft, and certain other miscellaneous deductions. Next, let's take a look at a few review questions.